Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Hello everyone. Now I will presentation about the nature of risk and regulation in banking. The next chapter is about banks, risk and the need for regulation. I want to ask you about what is a bank. Um, do you know a bank is an institution which holds a banking license, accepts deposits, makes loans, and accepts and issues checks. Um, in contrast, a financial service company is an institution that offers its customer a financial products such as a mortgage, pension, insurance, or a bond. And the above definition highlight the difference between a bank and a financial service company. While a bank is a financial service company is not necessarily a bank. It is important to understand that the regulation of banks is different from the regulation of the financial service industry. Banking regulation is a subset of the overall regulation of financial service. And the next is what is risk. The dictionary definition of risk is the chance of disaster or loss. For purpose of the certificate, risk is defined as the chance of a bad outcome. This implies that risk only relates to situation where a negative outcome could occur and that the likelihood of such an outcome can be estimated. And there are two other risk-related terms are important for the purpose of the certificate. The one is risk events. Risk event is defined as the occurrence of an event that creates the potential for loss or a bad outcome. And the second is risk loss. Risk loss refers to the losses incurred as a direct or indirect consequence of the risk event. Such losses can be either financial or non-financial. And the next chapter is the next content is financial service industry, banks, and regulation. The financial service industry is also subject to regulation to protect customers and increase confidence in these products. Banks, however, are subject to further regulation. Indeed, in the case of banking regulation, it is the institution itself that is strictly regulated, not simply the products and service it offers. While it is common to have regulation covering the products or service an industry offers, it is more unusual to have every institution in the industry regulate. And the next is why regulate a bank? The need for banks to be regulated as institution has its origins in the risk inherent in the system. Unlike the car industry, banks offer a product that is used by every single commercial and personal customer money. Thus, the failure of a bank, either partial or total, can affect the entire economy and is referred to as system, systemic risk. Systemic risk is the risk that a bank failure could result in damage to the economy out of all proportion to simply the immediate damage to employees, customer, and shareholder. And the next is about bank risk regulation. Bank risk regulation have Basel um, Basel 1 and Basel 2. In the Basel I, the market risk amendment, the Basel Committee published the market risk amendment to the original accord in 1996. In addition to creating a simple set of rules for calculating market risk, the Basel Committee encouraged supervisors to focus on appraising the models being used in risk-based pricing. And the next is Basel II. First is the coverage of market risk in Basel II is substantially unchanged from the 1996 amendment and its subsequent revision. And the second is the Basel II Accord also has provision for other risks to be taken into account when calculating the risk-based capital of a bank. However, these are not covered by a model approach. And the next is the Indonesian banking system and regulate. The Indonesia banking system, the Indonesia banking system first is banking legislation in 1992 and 1998 create two types of bank within Indonesia. Commercial banks offer a full range of financial services, including foreign exchange service. They have access to the payment service and provide general banking service. People credit banks, known as BPRs, are much smaller than commercial banks and are usually operate locally. They can accept deposit but do not have access to the payment system. In addition to banks, there are small non-bank institutions such as village credit institution, BKD, and rural credit unions or EDKP. And the next is about banking regulation. The regulation of the banking system has developed rapidly since 1998 in response to the many challenges presented by the domestic financial marketplace. Many areas of the financial market have been covered by new regulation, thus creating comprehensive regulatory framework. In addition, Bank Indonesia has published the Indonesian Banking Architecture, which sets out the direction, outline, and working structure for the banking industry over the next 5 to 10 years. The change will be implemented in steps covering the following objective. First is to reinforce for the structure of the national banking, and the second is to improve the quality of banking regulation. The third is to improve the supervisory function, and the fourth is to improve the quality of bank management and operation. The fifth, and to develop banking infrastructure, and the last is to improve customer protection. And this is my presentation. Thank you for your attention, and I'm sorry for my shortcoming. And see you in the next presentation again. Bye.